Hello viewers and subscribers, and welcome to today's video. In this video we'll be continuing the tax theme that we started in the last video, and we'll be looking a little more in depth into deductions and tax credits for individuals. Deductions reduce your taxable income, while tax credits reduce your taxes dollar for dollar and are more valuable than tax deductions. There are two main types of deductions: the standard deduction and itemized deductions. And you can choose whichever method gives you the larger deduction. So if itemized is higher, you use itemized. If standard is higher, you use standard deductions. So let's talk a little more about standard deductions. Standard deductions are amounts set specifically by the IRS, and if you choose to use a standard deduction, you have to use that specific amount. The standard deduction varies based on your filing status. For 2023, the standard deduction limits are as follows. If you're single or married filing separately, it's $13,850. If you're married and filing jointly, or you're a qualifying widow or widower, it's $27,700. If your filing status is head of household, it's $20,800. For individuals older than 65 or are blind, there are additional amounts allowed for the standard deduction. If you're single or head of household and 65 or older or blind, an additional $1,850 is allowed. If you're 65 or older and blind, you're allowed an extra $3,700. If your filing status is married filing jointly or separately, and you're a surviving spouse, age 65 or older or blind, it's $1,500 additional per qualifying person. So let's repeat that. Married filing jointly or separately, and you're a surviving spouse, age 65 or older, or blind, then it's $1,500 per person. If you're married filing jointly, 65 or older, and blind and surviving spouse, then it's $3,000 per person. So the difference here is whether you're 65 or older or blind, one or the other, or 65 or older and blind. That means both. That doubles the additional amount you're allowed. That's standard deductions. Itemized deductions. If your itemized deductions exceed the standard deduction, then it makes sense to use the itemized deductions. And some of the main itemized deductions include medical and dental expenses. For these, you can deduct the amount that exceeds 7.5% of your adjusted gross income. And this includes things like expenses for diagnosis, treatment, prevention, and transportation for medical care. It also includes payments to doctors, dentists, surgeons, and any other medical practitioners. Also prescription medications, things like insulin, medical equipment and supplies, health insurance premiums if not already paid with pre-tax dollars. So a lot of things there you can deduct for medical expenses. Another very popular itemized deduction is state and local taxes, or SALT for short. You can deduct state and local income taxes, sales taxes, and property taxes, but it's limited to $10,000 per return, or $5,000 if you're married filing separately. Another itemized deduction is mortgage interest. Mortgage interest paid for a primary residence and a second home is deductible, and it includes interest on home equity loans and lines of credit if the funds were used to buy, build, or improve the home. And interest is allowed on up to $750,000 of mortgage debt, or $375,000 if you're married filing separately. For mortgages taken out before December 16, 2017, the limit is $1 million, so that's a higher limit. Charitable contribution then is another itemized deduction, and you can deduct contributions to qualified charitable organizations. You can deduct cash donations or non-cash contributions, for example, clothes, household items, etc. Mileage driven for charitable purposes is also deductible. There is a limitation, as charitable contributions are generally limited to 60% of your adjusted gross income for cash contributions and 30% for non-cash contributions. You should always keep records of your donations, especially if it's over $250. Okay, as we move on, another itemized deduction is casualty and theft losses. Losses are allowed only in federally declared disaster areas though, so it's not a general deduction that's allowed. And the incident must exceed $100 and 10% of your adjusted gross income. And it covers things like damage to homes, vehicles, personal property, and losses due to theft as well. Okay, that's it for the main itemized deductions. Now let's look at what is called above the line deductions. Above the line deductions reduce adjusted gross income and can be taken even if the taxpayer does not itemize deductions. Some of the main above the line deductions include things like educator expenses, and you can deduct up to $300 of unreimbursed expenses for classroom supplies for K to 12 educators, teachers, counselors, principals, or aides. You can also deduct for classroom supplies and professional development courses. Health Savings Account, or HSA, contributions is another above the line deduction. You can deduct contributions to an HSA if you have a high deductible health plan. The contribution limits for 2023 are $3,850 for individual coverage and $7,750 for family coverage. You're allowed an additional $1,000 catch-up contribution if you're 55 or older. Self-employed health insurance premium is another above-the-line deduction. You can deduct up to 100% for health, dental, and long-term care insurance premiums if you have self-employed health insurance. Alimony payments is another above-the-line deduction, and it's deductible for divorce agreements executed before 2019. So nothing after the year 2019. Student loan interest is also an above-the-line deduction. You can deduct up to $2,500 of interest paid on qualified student loans. This phases out at higher income levels though, so the benefit might be limited depending on your income. Retirement contribution, that's also an above-the-line deduction. You can deduct up to $6,500 or $7,500 if you're 50 or older. And that's allowed for a traditional individual retirement account. Though it depends on your income and whether or not you're covered by a workplace retirement plan. If you have a 401k or other workplace retirement plan, this might limit how much you can deduct from another retirement plan that you're funding outside of your workplace. Self-employed retirement plans include SEP IRAs, simple IRAs, and solo 401k plans. We covered these in a previous video, so you can go back and take a look at that to get some more insight into the type of retirement plans there are. Moving on now to self-employed tax deductions. Self-employed individuals can deduct many business expenses. These include home office expenses. So if you use a portion of your home exclusively and regularly for business, you can claim this deduction. The deduction is based on the percentage of the home used for business times expenses spent on the home for the year. And it's typically based on square footage. So it's the percentage of square footage that you use for your business divided by the total square footage of the house times your household expenses for the year. And some of the home office expenses that you can deduct include mortgage interest, property taxes, utilities, repairs, insurance, and pretty much any type of expense incurred for the home. Let's look at an example. If 500 square feet of a 2,000 square foot home is used for business, 25%, that is 500 divided by 2,000, of all expenses for the home can be deducted for home office expenses. You can also decide to forego this calculation and just use a simplified method, which is $5 per square feet up to 300 square feet. So you can use that in lieu of the actual expenses method. Vehicle expenses is another self-employed deduction. You can deduct your expenses spent on vehicles used for a business or use a standard mileage rate of 0.655 per mile for 2023. So here again is another expense that you can deduct, and you can choose to use your actual expenses that you spent on the vehicle, or you can actually just use a simplified method, which is the mileage rate for the particular year. Just multiply that by the amount of business miles driven. Self-employment tax deduction, that's another business deduction that you can take. As a self-employed individual, you pay self-employment tax on your business income, separate from your regular income tax. Half of the self-employment income is deductible as a business expense. The next business deduction is qualified business income deduction. As a business owner, you're allowed a deduction of up to 20% of your qualified business income, and it's subject to certain eligibility rules. That was it for self-employment deductions. Let's now take a look at some other noteworthy deductions that you can take. A couple of the notable deductions include moving expenses. These are allowed only for active duty military members if they are moving due to military orders. So no one else can benefit from this deduction. Gambling losses, you can also deduct gambling losses up to the amount of your winnings from gambling. Those are two other deductions that you should be aware of. Let's now take a look at income phase-outs. Many deductions phase out at higher income levels. As a taxpayer, you should be aware of these limitations for your specific situation, and your tax preparer can help you with this. And that's it for tax deductions. We'll now go into part 2, which is tax credits. So let's talk about tax credits. As I mentioned earlier, tax credits directly reduce the amount of taxes you owe, dollar for dollar, and is more valuable than tax deductions. The benefit you'd get from a tax deduction depends on your tax rate. For example, a taxpayer with a rate of 15% would save $15 in taxes for a $100 deduction, while a tax credit of $100 would save the taxpayer $100 in a similar situation. For the deduction, you're taking that $100 in income and multiplying it by your 15% tax rate, and that would be your tax savings. For the tax credit, it's the entire $100 that you would save because it's a credit against the taxes that you owe. Let's take a look at a dozen of the most popular tax credits. First one is the Earned Income Tax Credit, or EITC. This is one of the most popular tax credits and also one of the most abused tax credits. The EITC is a credit for low to moderate income working individuals and families. And the credit amount varies based on your income and the number of dependents you have. Taxpayers must meet certain requirements to qualify for the EITC. And these requirements are: 1. You have worked and earned income under $63,398. Your investment income is below $11,000 for the year, and you have a valid Social Security number. You must also be a U.S. citizen or a resident alien all year, and you must not have filed Form 255, which is foreign earned income. And you also must meet certain rules if you're separated from your spouse and not filing a joint tax return. The maximum amount allowed for the EITC is, if you have no children, you're allowed $600. One child, you're allowed $3,995. For 2 children, $6,604. And 3 or more children, $7,430. Next up is the child tax credit. And this tax credit is paid to individuals with qualifying dependent children. A qualifying child must be under 17 years of age at the end of the tax year, have a valid Social Security number, and must be a U.S. citizen, U.S. national, or U.S. resident alien. And there are also some other eligibility requirements, which we'll not get into in this video. The child tax credit allowed for 2023 is up to $2,000 per qualifying child under 17, and up to $1,500 of that credit is refundable. What this means is that if the credit reduces the tax owed to 0, then the taxpayer can still get back up to $1,500 as a refund. The child tax credit does phase out at $200,000 of adjusted gross income or $400,000 for married filing jointly. Third credit is the child and dependent care credit. This credit helps offset the cost of caring for children under age 13 or for a spouse or dependent who is unable to care for themselves. And the credit is up to 35% of $3,000 in qualifying expenses for one child or dependent, or up to 35% of $6,000 for two or more qualifying children or dependents. The percentage allowed reduces as your income increases. The fourth tax credit we look at is the American Opportunity Tax Credit. Now, this credit is available for qualified education expenses for the first 4 years of higher education. And it's as follows. For college expenses, up to $2,500 per eligible student, and it's 40% of that is refundable up to $1,000, and it phases out between $80,000 to $90,000 of adjusted gross income, or $160,000 to $180,000 if you're married filing jointly. Another education credit is a lifetime learning credit. This credit applies to qualified tuition and related expenses and is for all years of post-secondary education and also for courses to acquire or improve your job skills. The amount allowed is up to $2,000 per tax return, and it phases out between $80,000 to $90,000 of adjusted gross income for single filers and $160,000 to $180,000 for married filing jointly. Number 6 is the Retirement Savings Contributions Credit, which is also called the Savers Credit. This credit is available to low and moderate income taxpayers who contribute to a retirement plan, such as a 401k or an IRA. The amount allowed is up to 50% of contributions to retirement accounts, with a maximum credit of $1,000 or $2,000 if married filing jointly, and the credit percentage reduces as your income increases. 7 is the Adoption Credit. This credit includes both a credit for qualified adoption expenses paid to adopt an eligible child and an exclusion from income for employer-provided adoption assistance. Qualifying adoption expenses include reasonable and necessary adoption fees, court costs and attorney fees, traveling expenses including amounts spent on meals and lodging while away from home, and other expenses directly related to and for the main purpose of the legal adoption of an eligible child. An eligible child is any individual who is under the age of 18 or is physically or mentally incapable of caring for themselves. And the credit is up to $15,950 per child. So quite a nice little credit there. But it also phases out as your income rises, as is the case with pretty much all credits. We're up to number 8, and that's the Premium Tax Credit. This credit helps to cover premium for a health insurance marketplace or Obamacare plans. The amount varies based on income and the cost of the plan. 9. Residential Clean Energy Credit. You can get a credit of up to 30% of the cost of eligible solar, wind, geothermal, and biomass fuel. Number 10. Electric Vehicle Credit. This is another popular credit. Up to $7,500 is allowed for new electric vehicles purchased, and up to $4,000 is allowed for used electric vehicles. And the credit is subject to income limits and also caps on vehicle prices. Number 11 is the Energy Efficient Home Improvement Credit, and this is 30% of the cost for eligible energy saving improvements. The annual limit is $1,200 allowed for most home improvements. And the 12th and final credit we'll mention here is the Foreign Tax Credit. This credit is allowed for taxes paid to foreign countries, and it's limited to the US tax on the foreign income. Those are some of the more popular tax credits allowed. It's not a comprehensive list, so there are other credits that can be had, but those are some of the most well-known ones. Some important considerations for tax credits. 1. Income limitations. As I mentioned earlier, many credits phase out at higher income levels. 2. Refundable versus non-refundable. Refundable credits can result in a refund even if they exceed the taxpayer's tax liability. Non-refundable credits can only reduce your tax liability to 0, but it cannot give you a refund if you're beyond 0. 3. Record keeping. You should maintain thorough record for all deductions and credits claimed. Pay attention to tax law changes. You should stay informed about potential changes to tax laws that may affect your deductions and credits. State-specific benefits. Check your state's tax rules for additional deductions and credits. And professional advice. Consider consulting a tax professional if you have complex situations or to ensure that you are maximizing your tax benefits. You always want to make sure you're getting all the deductions and credits to which you're allowed. Understanding available tax deductions and credits is important for minimizing your tax liability and increasing your refund. So we have covered some of the main deductions and credits for 2023, but tax laws are complex and subject to change. Therefore, you should always verify current tax laws and seek professional help for your specific situation. And to close, this is a reminder that this video is for informational purposes only and should not be considered legal or tax advice. Always consult with a qualified tax professional if you need personalized tax guidance. This brings us to the end of the video, and this is the part where I ask you to kindly like, share, and subscribe. And we'd love to hear what you think about the video. So please let us know by posting a comment. Stay well and see you in the next video.